Hello, I'm KORST. The name comes from Korea and stocks. My goal is to deliver news about Korean stocks, the economy, and culture to the world as quickly as a ghost. Alright, let's get started. But before we begin, I want to say one thing. Everything I talk about here is simply my personal interpretation of news and economic developments in Korea. This is not investment advice. The content of this video is based on news reported in Korea and my own interpretation of it, and investment decisions should always be made after doing your own research and thinking carefully. Please keep that in mind. The global news cycle has been pretty chaotic lately, hasn't it? Thanks to global platforms like YouTube, people in Korea can follow international economic news very quickly. Recently, we've seen stories ranging from Blue Owl Capital suspending redemptions in one of its private funds to BlackRock placing redemption limits on parts of its private credit funds. These kinds of developments can definitely affect global financial markets. But among all the news stories right now, there's one issue that is having the biggest impact on the Korean stock market. That issue is the war involving Iran. The reason is quite simple. South Korea is extremely dependent on imported energy. The United States produces a large amount of oil domestically, so when oil prices rise, the economic impact is relatively limited. But countries like South Korea, Japan, and Taiwan rely heavily on imported energy. And when oil is shipped to Korea, there is a route it almost always has to pass through. That route is the Strait of Hormuz. About 20% of the world's oil shipments pass through this narrow waterway. Think of it like this. If the human body needs blood to circulate properly, the aorta has to function. Now, imagine that artery getting blocked. Pretty terrifying, right? The Strait of Hormuz plays a similar role in the global energy system. And right now, because of the war, this route has become dangerous and potentially disrupted. When that happens, oil transportation becomes more difficult, and naturally, oil prices rise. The Korean economy is structurally built around importing energy, manufacturing products, and exporting them to the world. So when oil prices increase, production costs for companies go up, and that inevitably affects the stock market. Recently, the Korean stock market has shown extreme volatility. At one point, the KOSPI index dropped nearly 12% in a single day. That kind of decline is something we rarely even saw during the COVID crash. It was essentially one of the largest single-day drops in the history of the market. On March 4th and March 9th, something very unusual also happened. The Korean market triggered circuit breakers. A circuit breaker is a safety mechanism designed to temporarily halt trading when markets fall too quickly. If the KOSPI falls more than 8% from the previous close, trading is suspended for 20 minutes. In simple terms, when panic spreads too quickly in the market, the exchange pauses trading to give investors time to calm down and reassess the situation. Historically, circuit breakers in Korea have been extremely rare. Since their introduction, they've been triggered only around 7 times, including during the 1997 Asian financial crisis and the 2008 global financial crisis. But this time, they were triggered twice in a very short period of time. That shows just how much volatility the market is currently facing. But there's an old saying in investing: great wealth is created during market downturns. So if we step back and look at the Korean market structurally, we might actually find opportunities in the current situation. First, it's fair to say that the KOSPI reaching 6,300 points may have been somewhat overheated. Of course, the semiconductor industry was performing very well. There was a lot of excitement around a potential semiconductor supercycle, led by companies like Samsung Electronics and SK Hynix. But at the same time, the market also rose extremely quickly in a short period of time. In Korea, recently there was an interesting phenomenon. On the subway, in restaurants, in cafes, everywhere you went, people were talking about stocks. When that happens, it often signals that the market may be overheating. At the same time, leverage in the market increased significantly. The amount of money borrowed to invest in stocks, what we call margin debt, increased by about 1 trillion Korean won in just 3 days, reaching around 35 trillion Korean won, roughly $23 billion, even though the KOSPI had already fallen sharply. In simple terms, when stock prices rise, more people borrow money to invest. But when prices begin to fall, those investors may be forced to sell their stocks. In Korea, we call this forced liquidation, or margin calls. On average, about $5.1 million worth of forced liquidations occur in the market. But on March 5th, the number surged to $52.8 million, more than 10 times the usual amount. So the market was already in a situation where some correction was probably necessary. And then the war involving Iran acted as the external spark that triggered the sell-off. Personally, I think the current situation could actually become an opportunity for long-term investors. When the war began, I converted about half of my portfolio into cash. And once the geopolitical situation stabilizes, I plan to start buying high-quality companies again. In the United States, you have the group known as the Magnificent Seven, companies like Apple, Nvidia, and Microsoft. If we were to think about a similar concept in Korea, I believe there are 3 companies that stand out. I call them the K3: Samsung Electronics, SK Hynix, and Hyundai Motor. Historically, there have been many cases where holding the largest companies in the market produced better long-term returns than buying the entire index. That's why I'm particularly focused on these 3 companies. What's happening right now is not due to internal problems in Korea. There is no war happening inside the country, and the fundamentals of Korean companies have not suddenly deteriorated. So, if the geopolitical situation stabilizes, there's definitely a possibility that the market could recover and move higher again. Of course, no one can predict short-term volatility. I'm talking about this from a long-term perspective. There is another important point to consider. For the Korean economy, 2 variables are especially important: oil prices and exchange rates. Since Korea has almost no domestic energy resources, it imports most of its oil. So when oil prices rise, production costs for companies increase almost immediately. Exchange rates are also important. However, many companies hedge currency risk through futures contracts and financial instruments. So in the short term, the impact may not be as immediate as oil prices. But if the Korean won weakens too much, the Bank of Korea may be forced to raise interest rates, which would put pressure on the stock market. That's why I personally believe it may not be too late to buy Korean stocks once the war situation stabilizes and the Strait of Hormuz becomes secure again. In other words, the potential closure of the Strait of Hormuz is a major risk for the Korean market. And if that risk is resolved, there is a strong possibility that the market could recover. There was also an important policy change in Korea recently. In 2026, an amendment to the Korean Commercial Act was passed. One of its key provisions requires companies to cancel treasury shares within a certain period of time after acquiring them. In simple terms, companies will no longer be able to use treasury shares purely as a defensive tool for management control. Instead, they will need to use them in ways that enhance shareholder value. This is considered one of the policies aimed at addressing the so-called Korea discount. Another interesting point is that the government has recently been tightening regulations on the real estate market. One reason for this policy direction is to encourage capital to move from real estate into the stock market. Korea also has local elections scheduled for June this year. In any country, governments usually prefer to avoid a major collapse in asset prices ahead of elections. So personally, I hope that once the war situation stabilizes, the market can begin another upward cycle. In my previous video, I mentioned that I would introduce other industries where Korea has strong global competitiveness besides semiconductors. Korea is also very strong in industries like shipbuilding, defense, and nuclear power. And with geopolitical tensions rising around the world, the defense industry has recently become a major investment theme. So today, I want to briefly introduce some Korean defense companies. Some of the most representative defense companies in Korea include Hanwha Aerospace, Hyundai Rotem, Korea Aerospace Industries, and LIG Next One. Among them, the company that many people consider the leader of Korea's defense sector is Hanwha Aerospace. The company experienced a major turning point after the war in Ukraine began in 2022. At that time, Korea signed a large-scale export contract with Poland for the K9 self-propelled howitzer. Since then, many analysts believe the company's growth trajectory has fundamentally changed. Even the Financial Times has highlighted Hanwha Aerospace as a promising defense company. Today, the company's major export markets are Europe and the Middle East. Since it will take European countries a long time to rebuild their own defense manufacturing supply chains, Korean defense companies currently have advantages in price, delivery speed, and product quality. Among these, Korea's biggest strength is delivery speed. The ability to produce and deliver weapons systems quickly has become extremely valuable in today's geopolitical environment. Hanwha Aerospace currently has export momentum in countries such as Egypt, Australia, and Romania, and it is also delivering the Cheonggung-2 air defense system to Iraq. Another interesting point is that the company is now competing for the U.S. Army's next-generation self-propelled artillery program. And as of now, the company has an order backlog of about 37 trillion Korean won, roughly $25 billion, which represents about 4 years of secured work. Because of this, many investors see Hanwha Aerospace as one of the core companies in Korea's defense industry. That's all I prepared for today. If you're curious about the Korean stock market or specific industries, feel free to leave a comment below. And if you found this video helpful, please like and subscribe. I'll see you again in the next video.